Hi, good morning. This is Dan Moorhead of Pantera. We have our whole investment team here for this call. We try and shake up the topics of the call. Sometimes we do a deep dive into Ethereum or DeFi. This is a much more generalist case for blockchain investing. We have the entire investment team on the call, also our CFO. If you have questions, go ahead and put them in the Q&A box. We'll answer them live as we go throughout the call, and then we're happy to stay on the call at the end to answer as many questions as you all have. For a little bit of the background, for those of you who don't know Pantera, I started out as the first asset-backed securities trader at Goldman, and now we're doing asset-backed tokens, so it's kind of a cool full circle, and then went to Tiger Management, where I was the head of macro trading and CFO. And throughout that time, it was all about finding asymmetric trades where the upside is much bigger than the downside. And I believe that blockchain is the biggest one of a generation. It's the most compelling trade I've ever seen. And so in 2013, we launched the first crypto fund in the United States and also the first blockchain venture fund. We have now launched 8 different products over the years and managed $3 billion. We have 4 different main strategies that we'll touch on briefly at the end of this. The interesting thing, or the most compelling thing for investing in this space, is it's just so disruptive. The returns are just so outsized. We've done 3 different venture funds. We've done 3 different early stage token funds, and then a Bitcoin fund and a liquid token fund. So 8 different funds, and some of those funds we've invested at the absolute peak of bubbles. And some of the funds, like our Bitcoin fund, we launched on the absolute low print of the last 9 years. But throughout all those bubbles and bursts, the average IRR of our funds has been 110%. And a lot of that credit goes to our investment team, who are fantastic. But some of the credit is that we're lucky enough to be in the most compelling space out there. And a little bit of the history of our fund launches explains where we're heading now. We did one fund that our first fund was just cryptocurrency and then just venture. And then we launched the first fund that was exclusively early stage tokens in 2017. And essentially that legacy left us with 4 separate funds. And that's great for some investors that have very specific liquidity needs or very targeted investment thesis on this industry. But most investors just want exposure to the concept of blockchain. And so we've just launched Pantera Blockchain Fund. And that fund does exactly what we've been doing for 8 years, investing in the full spectrum of assets in the space, venture equity, tokens prior to them going public, and then also the very big liquid tokens like Bitcoin and Ethereum. The change is we're doing that all in one fund now. So investors can make a decision to have 30 basis points or whatever of their AUM in blockchain as a concept, and then we will dynamically allocate between these different opportunities within the fund. And with that, I want to hand it over to our co-CIO, Joey Krug, to describe the thesis of why we think this is the most compelling opportunity of a lifetime.
Thanks, Dan. So at a high level, our thesis is that if you look at blockchain tech and cryptocurrencies, they're the underpinnings or beginnings of a new financial infrastructure, similar to how the internet was the beginning of a new information infrastructure. And if you look at the internet, it changed both how information was consumed, but also how content was created. In most prior information revolutions, the average person wasn't creating content, but the internet, it really democratized access to do that. And we think the same thing is happening here, but with finance. And so if you look at the history of protocols throughout time, initially you had Bitcoin, which was this global currency that solved the double spend problem, the problem of how do you send money from point A to point B globally without somebody counterfeiting it, without somebody spending the same money twice. And that was a really hard computer science problem that people had tried to solve for decades. And prior to Bitcoin, the main solution was, well, you just trust this third party and they'll be honest. And in practice, that doesn't work because the third party can behave badly, or the third party can be shut down. So Bitcoin solved that problem. And not a whole lot changed in the space until you had Ethereum come out that launched in 2015. And with Ethereum, the idea was, what if you take this kind of global low fee way of transacting, 24/7 that Bitcoin enabled with money? What if you add financial contracts on top of that? And so what Ethereum does from a literal standpoint is it lets you program the money. So it lets you write computer programs that move money around, which is really interesting. Those are called smart contracts. And then the last kind of evolution that we're having is the scalability evolution. So you have things like Polkadot, Ethereum 2.0, things like Arbitrum, which are layer 2s on top of Ethereum, that are basically enabling much higher transactions per second. Ethereum does about 20 per second. Visa does, the number of people throw around is 2,000. And then, exchanges on Wall Street do even higher. And so this is a problem that needs to be solved, and it is actually being solved. A bunch of these solutions are either already live or going live pretty soon this summer. And so if you look at, what's happening in the space, kind of tying this back to our thesis, we think that, decentralized finance has really 5 main components. And then just like in any financial system, there's, 1,000 other things that support the main, critical components. But in any financial system, you need a unit of account. So some asset to denominate trades in. In crypto, in the early days, that was actually Bitcoin. These days, it's mostly stable coins. So USDC, Tether, DAI, which is a decentralized stablecoin, things like that. Then you need an exchange, so you need a venue to trade assets on. And we've seen a huge uptick in adoption among decentralized exchanges. Things like Uniswap now regularly do volume numbers that are 30 to 40% of what you would see a site like Coinbase put up, which is pretty impressive considering that Coinbase has, I think, between 1,500 and maybe 2,000 employees, and Uniswap has maybe between 15 and 20 employees. Next up, you have lending and issuance. So you need assets to trade. So that's like issuance of new cryptocurrencies. We're also eventually going to see, I think, issuance of securities on public blockchains, but that's probably a good ways off. One thing that we are seeing is issuance of derivative assets. So protocols like Mirror enable you to trade synthetic versions of Apple or Tesla or Google or whatever it is, 24/7 globally. And that's sort of a use case that's kind of obvious and it makes sense and works pretty well because it doesn't rely upon the real world too much because they're cash settled, they're purely synthetic. And then you have lending, the borrowing lending markets in crypto. They're primarily kind of perpetual markets in the sense that they're floating rates. So you go to Compound or go to Aave, and most of the time you're just kind of lending out there, letting your capital sit there, and the rate floats. There's kind of new approaches that people are taking to try to create more fixed rate lending in the space. As the space matures, I think that'll become more and more common. And then the last 2 components are margin and leverage. And these are just things that you need for any financial market to function. The people tend to have a negative connotation with these, but the example I've used literally probably a few thousand times at this point is that if you're a business and you're trying to hedge currency risk, say you're trading dollar euro and your business that interacts with Europe and the US, doing that at 1x leverage where you have to post full collateral just doesn't make sense. It's incredibly capital inefficient. So those are reasons why things like margin and leverage actually make sense even for people outside of pure speculators. And so if you look at DeFi, the way we think about the stack, in computer science, we'll kind of like use the term stack, like what's the tech from like the very bottom layer to the top that the user actually sees. And in crypto, I think, the bottom layer of the stack is obviously the underlying blockchain itself, whether that's Ethereum or Polkadot or Near or Bitcoin. Then you have really kind of core infrastructure, things that get real world data into the blockchain. Those are called oracles, things like API3, Chainlink, and Augur. If you go one layer above that, you have protocols that actually in some cases have UIs on top of them. So a lot of the things I listed in the last slide. If you go a layer above that, you sometimes have protocols that use other protocols as part of their protocol. One example of this actually is Perpetual Protocol. They just launched a new version, or they're going to launch a new version soon, that uses Uniswap v3 for their trading engine. But Perpetual is actually a decentralized derivatives exchange. And so they're using other protocols beneath them on the stack to make their product work. And then if you go up a layer above that, you have products that use multiple products. These are things like aggregators or wallets. In traditional tech, you'd think of Netflix as an aggregator. They aggregate, movies and TV show content. You don't have to download the CBS app or whatever. You can just go to Netflix and get, a huge range of content. And in crypto, these tend to be financial things. 1inch and Instapp, a good example of this. 1inch will route your order across, dozens of decentralized exchanges to get you the best price. Instadapp is a lot of their focus is around the lending and borrowing markets. So getting you the most efficient rate if you're a lender, that sort of thing. And so if we look at it, quantitatively, DeFi has grown quite a lot in the last couple of years. In January of 2020, the amount of value locked in DeFi is sort of a rounding error. Today, it's over 110 billion. The way I think about value locked is literally just how much value is circulating in this new parallel financial system is kind of one way to think about it. And it still has a long way to go because there's many tens of trillions in the existing one, and we're only at 110 billion. But 2 years ago we were basically at zero. So it's growing very, very, very rapidly. And then the next category is a more specific use case within DeFi. That's decentralized exchanges. Decentralized exchanges, in July of 2020, they did about 5 billion in volume. June of this year, they did about 87 billion. There has been a bit of a drop off since the run up in May because prices of everything are down quite a bit. And so if you look at trading volumes, they're going to growth comes from two components. One is like growth within DeFi, and then two is price changes are going to cause growth or declines as well. But if you look at these charts over the past year, they've grown much more than the price appreciation, which means DeFi is growing not only with crypto, but on a relative basis, it's outpacing the growth of the overall market. And with that, I'm going to hand it over to Paul to talk about some of the other areas of focus.
Hey guys, this is Paul. I'm calling in from Paris here for the blockchain conference. In terms of other areas of focus, so yeah, these are the 6 that we have categorized as areas that we've made some significant investments in. Most of these are centralized companies, but they are bleeding into decentralized finance. So I can get into some of those companies too. But on the infrastructure side, we led the Series A of Alchemy, and they are the leading blockchain technology and developer infrastructure company in the entire space. So they've processed over $30 billion of volume through their infrastructure. They also, sort of service 70% of the Ethereum ecosystem in terms of decentralized applications they're building on top of their infrastructure, which is both nodes infrastructure and also developer APIs. And they are expanding over to other blockchains and scalability solutions like layer 2 polygons and other layer 1s. And we're really excited that they are really providing all of the tools necessary for developers to build. And when you make it easier for developers to build, the ecosystem is going to grow. So we're going to probably continue to invest more into developer tools, especially for other blockchains or other tools that, higher up the stack. And then on the enterprise side, we invested into Off-Chain Labs, actually led the seed round, and they are in high demand for, subsequent growth rounds right now. They are providing a layer 2 scalability solution for Ethereum. So it's going to be really easy for sort of new applications and even existing applications that are getting into blockchain to be able to build on top of Off-Chain Labs and be able to have much more throughput. And we actually think that layer 2 solutions are going to be a sustainable strategy for Ethereum to scale. I think there's also other enterprise solutions that Off-Chain Labs can kind of get to, especially around privacy. And then on the payment side of things, we're looking at both business to business and also consumer payments. So on the business to business side of things, small and medium businesses, anywhere from a few $1,000s all the way up to hundreds of thousands of dollars cross-border payments. So if you're able to do that using cryptocurrency as rails, basically moving from local currency to crypto, back to local currency, or maybe even using things like stablecoin, it makes cross-border payments a lot more seamless, especially for the small and medium businesses where banks are sort of charging them quite a bit of fees and it takes quite a bit of time to send money across borders. Veeam solves that. It's basically the Venmo for business-to-business payments using crypto as a backend. And I think we're also going to see a lot more consumer applications are revolving around payments using stable coins. I think that's a trend that's going to continue to get larger and larger. And then on the consumer side of things, we are investors in Bakkt, and they are ICE-led, Intercontinental Exchange, which is the parent company of the New York Stock Exchange. They allow anybody to have their cryptocurrencies and digital assets in a consumer wallet and be able to have it spent. So with partnerships that include loyalty points, airline miles, really kind of creating an all-encompassing consumer solution for the tokenization of any sort of asset, as Joey mentioned, eventually moving over to real-world assets too. So we think that's going to be really interesting. And we're also getting into NFTs. We just closed on a really high-profile NFT deal on the consumer side. On the exchange side, we are looking all across the world where cryptocurrencies make even more sense for store value and even cross-border payments. So Bitso is a great example of that. They are the leading exchange and brokerage in Latin America, starting with Mexico and expanding over to Argentina, which they're also dominating, and into Brazil. And so they account for about 9% of the remittances between US and Mexico using cryptocurrency underneath. They have over 1 million users. It's extremely exciting to see that much adoption on the consumer side. And then we're also in areas like Indonesia and Pintu, where they're also bringing adoption to the underbanked over there. And they even have their own stablecoin, which could turn into a central bank digital currency. That area is also fascinating. And then the last area that we are investing into is financial infrastructure. So one great example of that is staking. As you can imagine, staking provides security and also helps to give more decentralization of this security validation governance for proof of stake protocols like Ethereum. Staked is our bet in the staking ecosystem, and they are servicing institutional clients and also potentially developers. I think where financial infrastructure moves to, we're starting to see a lot of things like structured products for DeFi, and we think that that's going to bring a lot more institutional investors into decentralized finance, and we have a few investments coming up in that area too. I'm going to shift it back over to Dan to continue the conversation on the markets.
Hey, Paul, thanks. First, before we go into the markets, I just want to highlight a big theme that we've been on all this year. Is there was a long period of time that just Bitcoin was plenty. It was most of the market cap. It was really all you needed, and it was a great proxy. And then Ethereum became important enough. You really kind of had to have Bitcoin and Ethereum to replicate the market. The market's now much more interesting, much more dynamic. And all the DeFi protocols that Joey and Paul have been talking about, are really important. We think they're going to be a very large fraction of the profits going forward. Obviously, Bitcoin and Ethereum have had incredible returns over the last 12 years, but going forward, we think other protocols will be the majority of the upside. And in January, in our investor letter, we said that although we're very bullish on Bitcoin, we're much more bullish on Ethereum and DeFi protocols built on top of it. And at the time, Bitcoin and Ethereum were 84% of the entire market. Everything else, the other 5,000 tokens, were just 16% of the market. Now it's 37%, and this is something that we think everyone should keep your eyes on. That Bitcoin and Ethereum are obviously very important, but things built on top of other protocols like Polkadot or Ethereum are going to be very important. Okay, so we've been really excited about blockchain for 8 years, but right now we think it's just an amazing opportunity. And there are a handful of very big tectonic shifts actually coming together at the same time. The first one is the monetary response to the pandemic has been literally off the charts. The amount of money the United States is printing in a month is now more than in 2 centuries of our country's existence. So just an incredible amount of paper money being created. And what that does is it pushes up the price of things whose quantity can't be eased, or as we've shown in this graph, it's flipping it upside down and putting the price of paper money priced in other units of account, being ounces of gold, bushels of oats, grams of sugar, things like that, oil, at the S&P 500. I think that's, to my mind, that's the best indication that there is just an incredible amount of paper money sloshing around, that stocks hit record highs in a global depression when corporate earnings were being crushed. So there are many ways you can hedge your risk of owning a debased paper currency. Even lumber has done very well, but the best has been Bitcoin or cryptocurrencies. That has brought in a lot of legendary investors into the markets. People like Stan Druckenmiller and Paul Jones are investing. An interesting point is both of them have said it reminds them of gold. And I get a question often from investors, why hasn't gold done better? As you saw in that previous chart, is actually one of the least well-performing assets out there. I think it's because it's losing massive market share to the digital gold of blockchain. So people, as they go into cryptocurrency, they're now essentially kind of passing up the old school gold and going to the new version. That's brought in a lot of corporations and institutions, which has credentialized the space. You have public companies buying a lot of Bitcoin. You also have major endowments getting directly invested in the space. And then firms like Morgan Stanley going live, essentially, and PayPal credentialize the space and make it a lot easier for investors to get invested. Okay, so thinking about why this is the trade of a generation. Looking for macro style trades, you're looking for things that have way more upside than downside. And obviously, when you invest in something, you can lose 1x your money. But in cryptocurrency, it's been averaging tripling every year for a decade. And so it's a very asymmetric trade. And this graph shows the size of the cryptocurrency market. It's 1.5 trillion, but it's disrupting markets that are absolutely massive. Tens of trillions, or even in the case of money, hundreds of trillions. And so the upside is a great deal more than the downside. Although Bitcoin seems super volatile, and in the last couple of months, it's moved quite a bit, but this graph shows the value of Bitcoin logarithmically over time, and it's actually pretty stable. There's definitely been a couple of bubbles. There's definitely been, a few deep bear markets, but over time, it does have a fairly consistent growth rate. It's been growing at 233% for 11 years. It is, there's no asset like that. The other attribute that makes it very amazing for a portfolio is not just its historical return, but the fact that it has no correlation with other asset classes. When I started out, I was a bond trader, and I came in every day and just thought about bonds. I had no idea what was going on in the equity market. I didn't care what was going on in gold or oil or whatever. But modern portfolio theory has been so successful that essentially everybody owns the same portfolio. And so risk on, risk off, everything goes together. To find an asset with a crazy historical return with zero correlation is a once in a lifetime thing. I will admit, in 10 years, when everybody does have a blockchain team and everyone has 6 or whatever % of their portfolio in blockchain, it will be highly correlated with the S&P and oil and all these other things. But for now, it makes it a dream asset. So one of the frustrations of potential investors in blockchain is how to value it. And I had a fun conversation with a Tiger Cup friend of mine who's a TMT investor, and he said, we don't trade Bitcoin because there are no cash flows to discount. I was like, well, there are no cash flows to the euro, and people trade that all the time. So the driver of the price of Bitcoin is supply and demand, and this old school Econ 101 style visualization is basically what it is that over time, more and more people are coming into the market, and you have shocks like when PayPal turns on 300 million people, it brings a lot more demand into the space. And then every 4 years, the supply of Bitcoin is cut in half, and so you have a shock the other way. And that typically drives the price of Bitcoin over time. And then the other way to visualize it is this table where we have the number of people using Bitcoin and then the price of Bitcoin. And over the last 10 years, both data series have gone up an order of magnitude every 2 years. And it really is amazing. There's only one time that it didn't match directly. It was off by a handful of months. but I've never seen a data series like this where two things have moved so incredibly much, but kept the same ratio. And if that persists, that would have Bitcoin at 200,000 next year. And although we're in a bit of a kind of crazy bear market where everyone's fearing for the worst, I think that easily could happen. Where could that ultimately take us? There's kind of a rush in the pundit community to throw out, forecast for Bitcoin, $1 million of Bitcoin or whatever. This one is based on some logic. On the next slide, we have what could ultimately be the value of Bitcoin. There are 3.5 million people on Earth that possess a smartphone, and that is the only thing you need to participate in the blockchain ecosystem. And if this ratio, which is held for 10 years, keeps holding, that would put Bitcoin at 700,000 at some point. I do think that is a potential likely future for 5-10 years out. Okay, so the market is in a bear market. There's a couple of big things that drove the market to come off. A few weeks ago was the most volatile week in Bitcoin history. The market moved 21% in a week. Three big things, in my opinion, are what were driving the market at the time. Two of them, I think, are very transitory, and one is real. Over the past 8 years, there's been three big run-ups / bubbles, and after each of those, the market peaked a bit right at the end of the year and troughed right before tax day. And you can imagine why that could be true, that a lot of the investors in the blockchain space are not kind of big, sophisticated institutional investors. They're more either younger or first-time investors, or just essentially crypto enthusiasts that don't normally invest or trade things. And you can imagine them putting essentially all their money into Bitcoin, and then halfway through the year deciding to sell that and buy Ethereum. And then in April the next year, their tax advisor telling them they have to pay 34% of their profits to the tax authorities. So they end up selling. And we saw that in 2013 and 2017. The markets peaked December 4th and 14th, and then troughed a week before tax day. If it's so obvious, why didn't we see it this time? We thought we did see it in February. We took a lot of our risk off. The markets came down 27%, and we put it back on. So the markets did come off and hit a trough 2 days before this year's tax day, which was May 17th, a month different than normal. Also, there's been a couple other kind of big dynamics. China banning Bitcoin, and then Elon Musk did a 180. And the only perspective I'd like to share on China banning Bitcoin is they banned Bitcoin 3 times already in my career, and the markets keeps going up. And they've also banned things like Twitter, Facebook, Google, and those keep going up. So China banning it is not necessarily a bad thing, and it might indicate that we're really onto something, and this is going to be really big. And then in our next investor letter, we're going to talk about the ESG issues that have become very front and center, and Elon Musk has helped drive. And the only punchline I would say to that is, if China actually did ban mining of Bitcoin, that would be wonderful for the ESG worries that some people have. All right, so is Bitcoin cheap, blockchain cheap? Should one be invested now? On the next slide, we have a couple of different perspectives on, was it a bubble? Is it a bubble? Where are we at? The graph on the left is the year-on-year return of Bitcoin as a proxy for the industry. And you can see in the 2013 and 2017 bubbles, it was literally off the charts. It was, way, way above, any kind of normal return. This time, it really didn't do that. It was not too high. And right now we're, 280% above where we were a year ago. So it doesn't feel like, we are massively overvalued. We'd like to remind people that investing in tokens, although they have a real-time price feed, is much more like early stage venture, and one should have a multi-year perspective. So we like to graph a 4-year return on Bitcoin, because it's a much more, kind of takes out the crazy wiggles. And because of the halving and other reasons, there does seem to be a 4-year cyclicality to the bubbles and the bursts and the bear markets. And on that measure as well, Bitcoin's at the low end of its range. So it doesn't feel like it's overvalued. And the last metric would be to look at Bitcoin's value relative to its 11-year trend. It's currently trading at 46% cheap to its trend. And as you can see in the bubbles, it again was way off the charts, and it rarely does trade this cheap to its trend. It's traded this cheap only about 15% of the time in history. So although the past doesn't necessarily predict the future, it does seem like it's a good time to get involved. And one perspective I'd like to share is that human nature is massively pro-cyclical. When Bitcoin's screaming at the highs and everyone's on CNBC talking about Bitcoin, that's when everyone wants to buy. The FOMO devil is whispering in our ears. And then when the market crashes like it's done over the last 3 months, it's tough to tell your boss or your spouse or whenever you want to buy some crypto. But that is actually the good time to buy. And this shows the flows into our Bitcoin fund, which has been in existence for over 8 years. And the gray bars show the percentage of time Bitcoin has spent in each of those buckets. And it's relatively normally distributed, most of the time kind of right around the trend or close to the trend. And then just a little bit of time at the very extremes. The gold bars represent the percentage of our inflows that came in at each bucket. And you can see that when Bitcoin's as cheap as it is now, 46% cheap to trend, we rarely get much inflows at that level or below. But then when it's at its highs, it's when everyone's super psyched to get invested and to get in. So we love to encourage people to kind of go against the cyclicality. And if you have the emotional or financial resources to do so, to get engaged in the market, because it's probably very cheap here. With that, I want to give a brief overview of our funds. Our current set of 4 existing funds cover segments of the spectrum of assets, and then the new blockchain fund covers the entire spectrum. I'll hand it over to Joey to talk about our hedge funds, and then I'll talk about the blockchain fund.
Thanks, Dan. So on the hedge fund side of things, we offer 3 different products. Starting with the very first product we launched, it's our Pantera Bitcoin Fund, which launched in 2013. It offers daily liquidity with passive exposure to Bitcoin. The idea is there's no lockup. You can come in or out on any daily window, and the fees are very low, and it doesn't trade at a premium or a discount to NAV. It just trades at NAV. The 2 other funds, though, are more actively managed hedge funds. And within that, we have 2. One is our early stage token fund. That fund has quarterly liquidity, and it gives you exposure to early stage blockchain protocols following a venture style model. So we're investing in companies or projects really, really early on. In the VC analogy, they'd be the equivalent of a seed or Series A investment. And we're basically buying these tokens up early before they hit the public markets. The focus tends to be around things in the DeFi space. In the earlier days, we did a lot of layer 1 blockchain investing, like we're one of the largest investors in Polkadot, as an example. But these days, most of the traction is happening around DeFi. That's kind of where the next wave of projects is happening. And then on the more liquid side, we have the liquid token fund. That fund's a quarterly liquidity hedge fund, which is trading the publicly traded tokens. I would say on average, it's buying things in the top 75 or so by liquidity on CoinMarketCap. And it's actively managed exposure. Again, what we're doing there is trying to build a diversified portfolio that's mostly non-Bitcoin underneath, with a large focus on DeFi that gets exposure to kind of all the main subsectors of DeFi. So decentralized exchanges, decentralized lending protocols, some insurance protocols, different types of projects that have created their own stable coins like Maker and Terra, decentralized derivatives exchanges, pretty much anything you can think of in DeFi, building a portfolio around that, buying and selling the things that we think are undervalued or overvalued relative to their competitors. An example might be trading, Aave versus Compound. And then on the BTC and ETH side, we do use those for a portion of the fund, mainly for risk management, because it's way easier and faster to de-risk a BTC and ETH position because of its liquidity. And then we also trade around the BTC ETH ratio when we think Bitcoin is either over or undervalued relative to the price of ETH. It's looking at performance, sort of across the firm. If you look at our venture funds, our first fund has an IRR, net IRR of 41%. Our fund 2 is 39.8%. And our fund 3 has an IRR of 175%. If you look at the token side of things, we've quoted things in terms of compound annual growth rates, because that makes a bit more sense than an IRR since they're liquid hedge funds. And on the Bitcoin fund side of things, that's 114%. It launched way back in 2013. Then we have the early stage token fund with a 72% compound annual growth rate, and then the liquid token fund with a 35% compound annual growth rate. One thing I would think is sort of interesting to mention is, and Dan mentioned that we've launched some funds basically at the peaks of market cycles. The liquid token fund was one of those. And, if you look at the data here, even if you invested, at the peak when that fund launched, the compound annual growth rate still 35% annualized since then. From an alpha generation standpoint, year to date, the early stage fund is up about 133%. Our liquid token fund's up about 153%. And for Bitcoin itself, is close to flat. It's up about 9% year to date. If you look at numbers since January 1, 2020, early stage is up 1,389%, liquid token funds up 856%, and Bitcoin is up 341%. And with that, I'm going to pass it back to Dan to talk about the blockchain fund.
Thanks. So on our current and existing funds, it's been very important to us to make them accessible. And so we have a minimum of $100,000, which is much lower than most hedge funds, on all of our existing funds. And in some cases, that's literally the lowest the statutory authorities will allow us to go. So it's been very important to help people get invested. We're essentially evangelizing a new asset class, so we want to get lots of people on board. We actually have 1,600 LPs, so it's very different than our old business where we had, only 20 or 30, $100 million type investors. But on the new blockchain fund, unfortunately, we have to have a minimum of 1 million to keep the number of LPs manageable. We are targeting 600 million. We did our initial closing on June 30th and raised a bit over half of that. We will also have closings on the end of each fiscal quarter coming up, September 30th and December 31st. It will be a mix of venture equity, early stage tokens, and liquid tokens. Venture will ultimately probably be 40 or 50% of the fund. All of our new deals are now going into the blockchain fund. We finished our venture fund 3 at the end of June, and now all deals are going into the blockchain fund. We are investing also early stage tokens in both of our funds, the early stage token fund and the blockchain fund, splitting deals based on the size of the two funds. The early stage token component will probably be 30 or so % of this fund. And then we will be investing in liquid tokens in this new fund. But very important to emphasize, it's not just buying Bitcoin or just Bitcoin and Ethereum. We'll be investing in the tokens we think will outperform. And for example, this year, Bitcoin is now up 5% year to date, and our liquid token fund is up 128%. So there's a ton of alpha to be had by investing in things that are not just Bitcoin and Ethereum. And we think it's a great time to invest, both because tokens themselves are very cheap and because there's an amazing amount of interesting deals. This is a graph of the number of deals we're actively working on our investment committee over time. We typically have around a dozen deals that we're very seriously considering, but we haven't actually closed and funded. We now have 20 something deals in that condition. So this is the most opportunity we've ever seen in our space. Here's a new stat that we haven't shared publicly before because it's kind of ludicrous, but our loss ratio. We've been investing in venture for 8 years. And in the normal world, you lose money on 2/3 of your venture investments, and then you hope 1 or 2 of them will make your fund. We've only lost money on 8% of our venture investments. And I think a huge amount of the credit goes to our investment team. who are fantastic, but part of it is we are lucky enough to be in the best space in the financial industry. So going forward, future doesn't always have to be the same as the past, but I think we still have another couple decades of very dynamic growth in the blockchain industry. And in particular, we still have yet to see a legacy financial firm buy a cryptocurrency company. And I think over the next 4 or 5 years, you're going to see a lot of that. So we're going to see a lot of strong exits. And the last slide is a slide with the terms. It's mainly set up as a venture fund, so it's a 10-year term. But we have a couple of differences. We're going to have known and fixed capital calls, or the schedule, at least it's fixed. At closing, we call 25% of the capital. And then at the end of each fiscal quarter going forward, we're going to have subsequent capital calls over the next year or two. And during the first 5 years, we will be able to reinvest proceeds from early stage tokens that go live into new early stage token deals. But after 5 years, all that will flow back to LPs. And we'll also be able to recycle 20% of the capital from venture exits, but then anything above that will flow back. If our first 3 funds are a guide, we typically have begun returning capital after about 3 years, and then after 4 or 5 years, returning multiples of capital. And so it's likely to be the way this fund goes. Did want to mention that we are now all vaccinated and traveling to engage with people in the space. It's been very popular. We've had a couple. We just had a lunch in Palo Alto and had a couple of lunches in New York, and people are generally really excited to get back and see each other and talk about the markets and make new friendships. So we will be traveling over the next couple of months to various cities, and would love to see you there. With that, that's the prepared remarks. We got a lot of fantastic questions. I'll take a few, and then Joe and Paul will take some. There is a bunch of questions on China. How is this ban different? Okay, so they've announced 3 bans so far. This one seems to have more teeth to it. The amount of hash rate, the amount of mining that's being done on Bitcoin has fallen in the prior 2-week period, the most it's ever fallen, and then cumulatively it's fallen 55%. So there is a very large reduction in the amount of mining power that's being pumped out into the Bitcoin network. We're doing a bunch of statistics to see how much of that is the price drop, because obviously as the price drops, some older mining rigs become marginally net negative, so they get pulled out. And so it's still an open question. We're going to publish that in the next few days in our investor letter, a bunch of statistics on the mining power. So it seems like this one is a bit more real than in past ones. The thing I said earlier is, if China was effective in banning mining, it actually, I think, is a net positive to our industry. There is a growing concern about the environmental impact of blockchains generally, and the Bitcoin brand blockchain in particular. It is very difficult to get any information out of China and Chinese miners. They're about the most secretive group of people on earth. But in the West, it seems like about 40 or 50% of Bitcoin mining is done with renewable energy. That's much higher than the US's average of 11%. So Bitcoin mining generally is very efficient or renewable. And the reason for that is essentially all the miners use the same chips. So their only competitive advantage is finding the least expensive electricity. And to do that is to go to places that have abundant electricity, but very far from the urban centers that need it. And so there are things like geothermal in Iceland or hydro in the northwestern United States that are very, very cheap because it's very expensive to transmit that electricity elsewhere. There's also a question about the Chinese digital currency. It is very important, and there was a question about its impact on the global markets. China has a 6-year head start on the United States in building a blockchain payment system. In 2019, they announced it, which they've been working on previously for 4 years. It's not a coincidence that they announced it 2 days after Facebook announced their version of a blockchain-based stablecoin. China, and so there was a great op-ed in the Wall Street Journal by the chairman of the CFTC, Chris Giancarlo, calling it America's Sputnik moment in finance. And for you youngsters, Sputnik was when the Russians launched a satellite into space, and the United States realized that it was way behind in a very important field. And this has galvanized the United States and other nations to get engaged. And it has a very big geopolitical impact because the United States exerts an extraordinary amount of power through its sanctions regime. It can basically destroy countries with banking. And if there, well, when there is a blockchain-based system that's outside the control of the sanctions regime, that will change the balance of power in the world. So the United States is now engaged building a Fed coin. The question on stablecoins and central bank versions of stablecoins, is it good or bad? I think it's net positive. We're excited because 100 million people use cryptocurrency now, but when you start having centralized central governments bringing out their own version, it will credentialize the space and bring billions of people into the space. Many of those people will find the central bank version of a cryptocurrency fine, but a lot of them will probably realize that the value of a digital dollar will be sinking at the same rate as paper dollars. So they will probably want to hedge their exposure or expand into things like Bitcoin and other cryptocurrencies. Another question is on the regulatory environment. In the United States and most countries, the regulatory environment has actually been pretty positive. Most of the agencies in the United States ruled a long time ago and very favorably. For example, the IRS ruled in 2013, which is really amazing, that cryptocurrency is property, so that if you hold it for a year, you get long-term capital gains tax treatment, which is much better than gold, which is taxed as a collectible, and it's much better than paper currency. If you bought the British pound in 1800 and sold it now, it would still be a short-term gain. Paper money is always taxed as short-term gains. The CFTC has always been very progressive. They have futures. The OCC lets any nationally chartered bank custody crypto. So all that's been great. The only agency that's left is the SEC. They admittedly have a tricky problem. They're trying to decide whether these really complicated distributed ledger technology things that are super space agey are either similar to or dissimilar to an orange grove that Mr. Howey developed in Florida in the 1940s. And over the next 18 months, I think the SEC is going to be forced to come out with rules on what is a security and what is not a security. And then the last thing would be an ETF. That's a really big question in space. 8 years ago, when we wanted to launch an ETF-like product, we looked at all the different choices and thought that an ETF would take quite a while to come out. So we launched Pantera Bitcoin Fund as a hedge fund with daily liquidity. So it's got all the benefits of an ETF, but it's technically structured as a hedge fund. The SEC's been, I think, has a much higher standard for Bitcoin than it does for other products. We had a great talk at our last investor summit from one of the commissioners of the SEC, Hester Pierce, on how the standards are just so much higher for Bitcoin than anything else. There are ETFs in crazy things like platinum and palladium, where one Russian oligarch manipulates the price of those metals. And Bitcoin, hundreds of exchanges trade $70 billion a day. It's impossible to manipulate Bitcoin. Last important question, the price forecast. We have been betting that Bitcoin in particular would hit 100,000 this year and 200,000 next year. It certainly doesn't have that momentum right now, but things do change very quickly in this space. Last year at this time, the markets were languishing, and then a few things came together and that got going. I think that the reasons that the markets have fallen are transitory. The whole tax day thing, that's over. The Chinese, kind of the angst about whether China's good or bad, and all that is going to play out. And I actually think kind of either way is fine. If they actually do shut down Chinese mining, that would eliminate some of the ESG concerns that people have. And then the subject of our investor letter that is going out in the next few days is taking a full spectrum view of ESG. There's 2 other letters in the ESG mantra, and on social and governance, blockchain is absolutely wonderful. It's bringing benefits to billions of people on Earth. And so I think when people really have a cold, hard look at ESG, they're going to realize blockchain is awesome for ESG, and certainly much better than a lot of big things in their portfolio, like tech monopolies. And with that, I'm going to hand it back to Joey to answer a couple of questions live.
Thanks, Dan. There are a few questions about like layer one protocols. How many will survive over time, or will there just be kind of one? And I think that's a very frequent question that people ask. I would say that there'll probably be a handful of layer one winners. So you'll have Ethereum for smart contracts, Polkadot for people who are kind of wanting to launch their own chains that use smart contracts, and then maybe a handful of others that serve specific use cases, or that have different approaches to scalability. There's things like Solana. The question also asked about Bitcoin maximalism. I don't think that we see it as something that's binary. Like you can have digital gold, i.e. Bitcoin, and smart contracts at the same time. Both of them are very beneficial. There doesn't need to be a winner versus Bitcoin or ETH. They're sort of complementary things that do different things. There's another question about what are the key drivers and determinants that would change our thesis in an early stage token, and then also what are catalysts that cause us to think about sizing with investments in general. I think in terms of our thesis surrounding any early stage investment, we're primarily looking at the team, the product, and the market. On the team side, we're trying to find teams that move very quickly or are quite aggressive. They don't necessarily have to have a ton of experience in the area that they're solving the problem, but they have to have either face the problem themselves or have a really creative solution to what they're trying to solve. The market size needs to be quite large, and on the product side, like, it needs to actually work. If you look at token projects, technical risk is actually still quite high. There's a lot of projects that just never ship, or they take many, many years to ship. And so trying to find things that are relatively de-risked from a technical standpoint, where they either actually already have a working prototype by the time we invest versus just investing at white paper stage, are kind of some of the things we look for. What would change our thesis is just if any of those things change. So if the team stops shipping at the same cadence they've been shipping at before, if they launch a product into market and nobody in the market's interested in using it, things like that. Sizing wise, sizing is primarily a condition of company versus us saying we want to invest XYZ amount. So if you look at early stage token deals on the seed stage side, they tend to be roughly $2 million checks, and then kind of on the equivalent of a Series A, it's more like 5 to 10 million. And there's some variance, but there's not a ton. It's not like we walk up to a project and say, hey, we want to invest exactly $1 million or exactly 20 million. It's more sort of defined by the round structure that the project's raising. And then there's the last question I wanted to address is somebody asked about smart contracts on Bitcoin, the upcoming Taproot upgrade for Bitcoin, and can smart contracts on Bitcoin compete with ETH in the future? And my view on that is I think that would be incredibly unlikely. So if you look at Taproot, it's an upgrade that does provide some privacy benefits to Bitcoin. It doesn't really enable much for if you wanted to add smart contracts on top. Jack Dorsey has an initiative recently that he kind of came out with to put smart contracts on top of Bitcoin, but I don't really think it makes sense. It's kind of trying to fit a square peg into a round hole. Like, Bitcoin's not designed for smart contracts. That's just not the path that the core devs have taken, and that's fine. Like, we don't own Bitcoin for purposes of thinking it's going to become a smart contract platform. We own it from a digital gold perspective, and so I think it would be unlikely if smart contracts on Bitcoin competed with ETH or Polkadot or anything else like that, for reasons like it's really tough to do smart contracts in the UTXO model. Bitcoin itself is extremely non-scalable, and you would have to rip out and replace so much code that it's not really worth the hassle. Instead, what you see happening is people will port Bitcoin over to other chains. Like on Ethereum, you have wrapped versions of Bitcoin. There's ways to do that in ways that are less trusted, where you have a network of people who basically are the ones that kind of lock and unlock the Bitcoin between Ethereum and the Bitcoin network itself. I think that's a better approach than trying to kind of slap or bolt smart contracts onto BTC itself.
Joey, there's a question I'll take on at a high level. What are the arguments for a non-stable token versus stable coins? They do different things. Stable coins are great for kind of retail commerce and remittance from migrants back to their families, all that kind of stuff. But they still have, they're stable with respect to another currency, either the US dollar or some other currency. And one of my favorite ways to think about this is Russia announced a bit ruble, and everyone's all excited about that. My view is it has some advantages. It's going to be borderless. You're going to be able to, transfer it real time, probably a lot cheaper than you can do, other ruble payments. So it has some advantages, but in the end, its price is going to be just as crappy as the ruble, right? So making it a bit version doesn't make it any better. And so I think in the end, a lot of savers, investors are going to want, Bitcoin, Ethereum, other non-stable tokens, because most of their non-stability is on the upside. They're appreciating with respect to paper money, which is being debased right now. Oh, and a question about the loss ratio. Venture markets do price relatively slowly, and so our marks are as of a few months ago. But most of the companies are still doing well. They're still making money, so it should. Our loss ratio is still very, very low. And then another question on liquid tokens, and do we create more value to the investor than the investor just investing directly in those tokens? That's a great question, and that's basically the basis of the entire hedge fund industry. Is why do hedge funds exist? Because you can just buy stocks yourself. It takes a lot of work to do the research. We have 15 people looking at different tokens and deciding which ones to buy and when to buy them. And obviously we need to outperform general markets net of fees and expenses in order to provide value to investors. But that would be the rationale, is that it takes a lot of people to keep up on. There's 150 tokens that are liquid enough to trade on real exchanges. So it's very hard for one person to do as kind of a part-time hobby. And with that, I think we've answered most of the major questions. So I want to thank you all for participating. And I didn't mention, but our hedge funds are open every month end. So to the extent you're interested in one of the early stage token fund or the liquid token fund, that takes in capital at the end of every month. Our Bitcoin fund takes capital any US banking day and has no lockup, so you can come back out the next day if you really wanted to. And then on the blockchain fund, we are able to take capital until the markets move materially. So if you're interested and able to engage very quickly, we can still take capital for our July 1st closing. And if not, we'll have another closing in September and then again in December. And if you do have questions that come to you after the call, just shoot them to ir@panteracapital.com and we will get an answer back to you. Thank you all.